class, and welcome to my Wednesday video. In this Wednesday video, we're going to go over um, some announcements and then the Chapter 10 content that we need to address for today. So we start with the announcements. Okay, I mentioned on Monday, I don't know how many of you were actually able to be there or how many of you have watched the video. But on Monday, I recorded a video and uploaded it into Canvas after our WebEx sessions. And I apologize because we had some difficulty again. By the way, for the next WebEx section or session, I've identified your email with one of the sections in the class that I'm teaching, the Accounting 202, and sent you an email invite to that session. Now, providing that everything cooperates, I look forward to being in that session with all of you. If we run into more trouble, I don't know. I'm going to do another recording. Basically, what I'm doing now is recording during our class sessions each Monday, Wednesday, Friday. So I'll keep that up no matter what. But if we can meet on WebEx on Monday, I prefer that. I would like to get to kind of check in with everybody and see that everybody is doing okay, and at least make some contact. But on Monday, last Monday, we had a problem with some folks couldn't find the link. We had a problem with on my end. This was nobody who was calling in, but this was at my end, and I don't know what happened, but I couldn't get video or audio at one point during the process. And so it just seemed one thing after another happened, and we had to move everything into video format on Monday. But since then, I've gone back to WebEx, and I've identified your email with one of the sections of the class, whichever one you're in, and sent you an invite to that particular session. Now, the other thing I want to mention is if you know the time of the meeting and you have my WebEx personal room number, all you need to do is to go to WebEx and search for that room number and we can meet. It's not dependent on me sending you the link, but I think that's more convenient and I'll keep that up. So you all should have a link for the session that you're in. Or be getting it very soon for the next session, which will be Monday, March 30th. Okay, so about announcements for today, I wanted to mention on Monday, I said our tradition in my class is that we regrade, we correct tests and then I regrade them. And I'm very happy to do that because I think you learn from your mistakes. However, in this online environment, it's a lot harder to figure that out and how it'll work. So instead of doing a physical correction of your test, which is impossible in this format, I have decided that the last test, one of the major areas where I saw some confusion at times in the multiple choice. By the way, I have to say on the last test, the majority of you really did well on the problems at the end of the test. In fact, I think the majority of you in the class got the majority of the points on those final 3 problems. So you did really well on those. But there were some language items in the other questions, I think, that may have tripped you up in some way. So what I've done is I have included this Chapter 6 extra credit assignment. It's grouped with the exams, so this will boost your exam score. When you click on the link, you'll get to this Chapter 6 extra credit. I'm looking at it in my view. Your view, you won't see it exactly like this, but you will be able to click on this link and get to this worksheet, which is right here. And this worksheet is basically a calculation or recalculation of what we did in Chapter 6. So you're going to start with calculating inventory, and then move on to absorption costing per unit, or per unit cost, absorption costing income statement, and then finally variable costing product cost and variable costing income statement. So what you have to do is fill in where the question marks are, uh, all the other data they give to you, but the area where you see question marks are where you need to fill in. Wherever they have a number, you don't have to do anything, but if there's a question mark, you need to put in an answer there in order for that to be a part of the solution. So anyway, that is the solution I've come up with regrading and correcting tests. So what I plan to do is grade these much the way I would grade test corrections, and then you will have some points added back for this as well. So if you are happy with your exam and you don't really need to do anything to it, if it was a great exam, and I know some of you really had strong exams this time, you don't have to do it if you don't want. That's fine. This is an optional type assignment, so I'm just laying it out there. Okay, the other thing I wanted to mention is in the Chapter 8 stuff that we did last week and concluded on Monday. The assignments are due today. So we actually well, no, we didn't do Monday. We concluded Chapter 9 on Monday. So due today, you'll find it in Chapter 8 module. There is a master budget assignment in Connect, as usual. And then there's also a Chapter 6, 7, and 8 vocabulary quiz. Okay, after today, after these are submitted, I will make active the Chapter 9 assignment, which will be due next week. So Chapter 9 will appear later today, but it's due a week from today, okay? Also, the Chapter 6 extra credit is due a week from today. So it's April the 1st that you'll need to submit that. Okay, so I hope that clears up some things. Those are the announcements that I think are important and relevant. Okay, I don't want that. All right. What we're going to do now is actually go to the actual. Okay, we're back with the PowerPoint presentation. There was, I guess, some difficulty opening it a moment ago. Anyway, we've got it open. Here we are. Standard costs are what we're going to talk about, and variances. So basically, when we're talking about standard costs, we're talking about setting standards that we try to meet with our products at the cost that we're going to incur to actually produce whatever it is we're producing. So we set a price standard, which means basically this is the amount we're willing to pay, or this is the standard we should pay for a quantity of whatever it is we're buying, whether it be a standard for the rate that we're paying our workers or a standard for the rate at which we're buying material. The quantity standards are going to relate to how much input actually goes into the product itself. So with a quantity standard, we're going to say we should only use a certain amount of this material in the product, a certain amount. Let's say we had a pound of material going into the product. That's all we should use. If we use less or more than that, we have a variance. Likewise, with labor hours, we should be able to do these products at a certain rate. So we assume that we are going to spend X number of hours of labor in basically getting this product put together. So those are both quantity examples. Price examples are about how much we're paying for what we're getting. When we talk about the standard price per unit, we're basically looking at the cost of materials that we're going to have. So we have that price for the materials that we've set, as a standard and how much we should actually use. I just mentioned this. Likewise, with labor, we have the rate per hour and the standard hours per unit. And by the way those things are determined often is we have efficiency experts in a lot of factories that will examine a production line or whatever it is that you're working on, or production process, and they will evaluate, okay, how much effort does this process require, and how much time do individuals spend actually completing parts of the process. So efficiency experts will look at the way that the machinery or whatever materials are arranged, and may look at that and say, okay, well, if we rearrange this production a little differently, we can be much more efficient with it. We can basically move the materials to another location, and we rearrange the machinery, we can actually produce at a quicker rate because it takes less movement to do that. So when we set manufacturing overhead standards, this is going to be the rate that we're going to set for manufacturing overhead, the price or the amount that we should be incurring when we make a product. This is the amount or the cost of overhead that we should be incurring. How many hours are allocated? Again, the quantity standard for overhead is going to be driven by usually machine hours or labor hours. So you're going to see something that would happen would be that you would see a similar variance in quantity for overhead like you would see if you were looking at labor hours or something. When we have standard cost, you'll see a card like this, and basically what this is it identifies how much material goes in, what the standard price is, and what the standard cost for the product should be. You'll notice direct labor is here and the cost per hour, and then we also have manufacturing overhead. So remember we were talking about variances when we were doing flexible budget. We're looking at activity and spending variances. Actually, the activity variance itself is a very useful tool, but when we look at a spending variance, it can be much more useful when we break that down, because if we're looking at a spending variance, it can happen in one of two ways, or multiple ways, I'll say it that way. So in general, at least for the purposes of this chapter, the variance analysis we're going to look at is what is the price variance and what is the quantity variance. The price variance is going to be the difference between the actual price we paid for the material and the standard price. And then the quantity variance is going to be the difference between how much of it we used, how much material or how much labor hours we used in the product or making the product. So these standards, price and quantity standards, are, like I said, they're useful because we want to identify what we should expect to incur for these, and we draw information from a couple of different places. For example, the purchasing, if we have a purchasing manager or maybe a buyer or somebody like that who's looking at the basically the context for purchasing this material, that is the marketplace environment. What is it like right now, and how much will it cost us? And so they can identify those issues and those problems. So we can also get into a quantity variance. So you'll notice here when we're looking at price variance, if we're looking at materials price variance, we're looking at the cost per pound. If we're looking at labor rate variance, it's the amount we're paying per hour for labor. And the variable overhead rate variance will be how much are we being charged per whatever hour it is that we're engaging in for the product. The Quantity variance breaks down into the materials quantity variance, which is how much of the stuff are we using to make it. The second item is a labor efficiency variance. And when we get to labor, we call it efficiency because if we use too much labor, we're not efficient. If we use the right amount of labor or less, we consider that to be efficient. The same thing would be true for variable overhead, especially if we're using labor hours to assign variable overhead. So here is the model for a variance analysis. And so we say we have a spending variance. When we were looking in Chapter 9 and we did the spending variance, we calculated what that was. Well, if we really want to break it down, we can break it down into the price variance and into the quantity variance. The first one, the actual price variance, we're going to take the actual quantity times the actual price, and then we're going to take the actual quantity times the standard price. And we're going to subtract the first one from the second one. So we'll say the standard price times the actual quantity versus the actual price times the actual quantity. Notice in the price variance, the variable that changes is the standard price or the actual price. And then when we go over to the quantity variance side, we're going to do something very similar to that. We're going to calculate what is the standard quantity times the standard price. We have a standard quantity times a standard price. We're going to calculate that. And then we're going to look at the actual quantity times the standard price. The difference between the standard quantity times the standard price and the actual quantity times the standard price is going to be our quantity variance. We can actually write these in formulaic forms that are much more efficient to work with, but keep in mind that right here in the middle of these variances, we identify, we have three basic positions here that we're looking at. The actual quantity times the actual price. We're looking at the actual quantity times the standard price. And then we're looking at the standard quantity times the standard price. And the way we look at those differences, those variances, is going to tell us which of those variances we're looking for. Again, there's a standard over here and the actual over to the left. So let's actually, at the end of this, we have the calculations they're showing us here, and they're going to move into an example. But what I would much rather do at this point, and I think would be much more helpful, we can talk about the example a little bit, but then we're going to go into this worksheet and the demonstration problems that I prepared for today. So let's take a quick look at this example, but then we're going to move into our actual demonstration problems. So it says here, Glacier Peak Outfitters has the following direct materials. Last month, 210 kilograms of fiberfill were purchased and used to make 2,000 parkas. The materials had a total cost of $1,029. So we're going to calculate the actual quantity times the actual price, which was the 210 kilograms times the 4.9 per kilogram that it should have been, or that they paid, sorry. And then we're going to take the actual quantity times the standard price. And the actual quantity is 210 kilograms times $5 per kilogram. And then we're going to take the standard quantity times the standard price, so we get $1,000. So what you're going to see in this variance analysis is that there's a favorable price variance because we got it for 10 cents less per kilogram than what we planned for in the standard. But over here, there's an unfavorable variance because we have a quantity variance. See, we said 1/10 of a kilogram per parka times 2,000 parkas, that's 200 kilograms. Well, what we actually used was 210 kilograms, so we used more of the stuff than what we had planned. Likewise, okay, well, let me just go ahead and use, oh, here's what I want to show you this before I get to the examples. So when we're talking about these variations or variances, one of the things that we can do, and my recommendation is that you simplify these formulas the way this slide shows you. When you're talking about materials price variance, you're going to take the actual quantity times the actual price minus the standard price in parentheses. When you're going to do a materials quantity variance, you take the standard price times the actual quantity minus the standard quantity. Okay? So that really, this slide, and by the way, this is the formulaic expression that we're going to use to calculate these variances in the examples that I have. So without further ado, let's take a look at these examples in Chapter 10. Now again, I'll have this worksheet in Canvas for you guys. I don't have it there yet, but I'll upload it as soon as I finish this video. All right, so for number one, we have this Woodson. Well, let's go up to the explanation. Woodson Wood Products manufactures various items from wood. One of these is a chair. During a recent month, the company manufactured 1,700 chairs using 8,205 board feet of hardwood. The hardwood cost the company $32,000. The company's standards for one chair are 5 board feet of hardwood at a cost of $3.85 per board foot. So they ask us first, what is the standard quantity of board feet that's allowed to make 1,700 chairs? Well, we're going to start with the number of chairs, the actual quantity that we made. We have 1,700. And we're going to look at the standard quantity per chair. So the standard quantity is right here, the 5 board feet of hardwood. So 5 is what we put here. So for each chair, we use 5 board feet, at least that's the standard, and we get 8,500 board feet, standard board feet allowed. Okay, then that is the standard quantity. Okay. And then we're going to move down to the standard materials cost. So we have the standard board feet allowed to make these chairs, which is this 8,500 number we just calculated. 8,500 here. Then we have the standard cost per board feet. Now remember, up here it was $3.85. Okay? So we're going to use that $3.85 here. $3.85. And then we're going to calculate this by multiplying these two together. We get a total standard cost of $32,725. Okay, now the materials spending variance is what they've asked us to look at next. So we've actually finished requirement number 1 and 2. What is the standard quantity of board feet allowed to make the chairs? What is the standard materials cost allowed to make the chairs? And then number 3, what is the materials spending variance? So here's what we want to do. We want to look at we've calculated the standard cost right here. See, we got that. Now we need to go up and figure out, okay, what did they actually spend? Well, they spent $32,000. So we have an actual cost of $32,000 right here. We have a standard cost of $32,725. And so what we have I'm going to do it. So what we have is a spending variance of $725. So this $725 is less than the standard. And when we look at favorable and unfavorable with Chapter 10, it's all going to be based on how it relates to the standard. So if you're under the standard in cost, it's favorable, okay? So we have a favorable spending variance right there. Now we're going to go to the materials price variance. So I wanted to put this formula here so you get used to seeing it, but in the materials price variance, what we're going to do is we're going to take the actual quantity, which was, let's go look, 8,205 board feet. So we have 8,205. We're going to multiply that by the actual price that we paid, which was this is calculated, the actual price that we paid is going to be calculated by taking the actual cost that we paid divided by the actual feet that we purchased. So when we talk about actual price, we're going to take 32,000 divided by 8205. That gives us $3.90 per board foot. So the actual price that goes into this calculation here is $3.90 minus the standard price of $3.85. Okay. So that's the calculation we want to use. So I'm going to put a formula in here. So there we go. It's $410, the materials price variance. So what we're doing here is actually calculating the price difference times the actual material we used. So the $410.25 is a materials price variance. And actually that would not be a favorable variance because we were paying more for the price than what we had in the standard. So it's an unfavorable. If we're looking at this as we're comparing this number, the result of which is this higher cost compared to our standard cost. So it's an unfavorable variance. We get to the materials quantity variance. We're going to calculate this one very similar to what we did with the other one. We're going to take the standard price of $3.85, and we're going to take the actual quantity of 8,205, subtract 8,500, and that will give us what we want. So we say 3.85 times, I know this is repetitive, but that's what they ask us to do, 8205 in Excel minus 8,500. And we get $1,135. Now, actually, we should not really consider this plus or minus, but this is below the standard, okay, so it's a favorable variance. Since it's below the standard, it's going to be a favorable variance. What I'm going to do is rework this a little bit so it doesn't come out with a negative number. still give us the same result. But when you're looking at these, we want to round these off to the nearest dollar, I would say. But here you'd have 410, here you'd have 1136. So that's demonstration problem number 1, showing you how to calculate these variances and these standard costs. In demonstration problem 2, and those were all related to material. In demonstration problem 2, we're really interested in labor variances and efficiency variances. So it says here that To Go Meals prepares packaged meals for busy commuters and grab and go. One of the products is a BLT on oat wheat bread with honey Dijon mustard. During the most recent week, the company prepared 8,000 of these meals using 2480 direct labor hours. The company paid the workers a total of $24,180 for this work, or $9.75 an hour. According to the standard cost card, it should require 0.30 direct labor hours at a cost of $10 per hour. So we want to look at first, what are the standard labor hours allowed to prepare 8,000 meals? If we're going to prepare 8,000 meals, we have a standard they've already set. So we're going to put in the 8,000 here because that's how many we prepared. The direct labor hour standard is 0.30. And so we multiply that times 8,000, we get 2,400. Okay, that's the total direct labor hours that are allowed. So that's the standard for labor hours. Now, what's the standard labor cost that's allowed? So we have the total direct labor hours that are allowed of 2,400. We have the standard cost per hour, which if we go up here, they calculated the standard at $10 an hour. So we have 10. So we have $10 an hour times 2,400 hours. We get 24,000 standard direct labor cost. That's what it should cost us. So now, for number 3, they want to know what the actual labor spending variance is. So they ask us, okay, what is the actual total cost incurred? And if we go up here, they tell us for labor, the total cost incurred was $24,180. So we come down here and we put in 24,180. And then we have a standard direct labor cost that we've actually identified for these. This is actually over here in number 2. I said above, but it's actually right here next to this. This is a direct labor cost. We have 24,000 in number 2. So the difference between these two is going to be the variance. It's a spending variance. And since the actual cost is above or higher than the standard cost, this is an unfavorable variance. If we're looking at this, and we will, that's why we use these to figure out, okay, what's favorable and what isn't. So that is the labor spending variance. Now we have number 4 that asks us to calculate the labor rate variance, okay? So we have, again, this formula that I mentioned from the PowerPoint slide, or one of the, this may not have been the actual, it may not have been focused on labor. I don't believe it was. It was on quantity of raw materials, but it works the same way for labor. So we have the labor rate variance. We're going to have actual hours worked, which is 2,480, because we'll go up here to these hours. Remember, we had these hours 2480 right here. We're going to pull that out, and we're going to say 2480 times the actual rate, which was $9.75, minus the standard rate of $10. Okay. All right, so when we get ready to put this in a formula, I'm going to rearrange it so we don't get a negative number, but we have 2480 times $10 minus 975. Now, if you arrange it the way the formula says, you will get a negative number, and that does indicate a favorable variance because it's below what the standard would be. So at the standard, this cost would be $620 higher. Because we're below the standard, we have a favorable rate variance, okay? And that's because we're coming out below those hours. Below that rate. So labor efficiency is concerned with the hours that we're spending. So we're going to start with a standard rate, which is $10 per hour. And we're going to multiply that times the actual hours of 2,480 minus 2,400 hours. And we get the solution to what we're looking at. When we get to this, we'll go 10 times 2480 minus 2400. Calculate that out, we get $800. Now, because the actual hours are higher than the standard hours, this is an unfavorable variance, okay? And I guess one way of thinking about this is when you're comparing the actual to the standard, if you look in these parentheses, if the actual is below the standard, it's favorable. However, if it's over the standard, it's unfavorable. So I hope that helps. Those are two demonstration problems from Chapter 10. I will record another one of these videos to give you some help with the Chapter 10 Foundational 15, and then we'll move into Chapter 11. So if you have any questions about any of this, be sure to let me know by email or contact me through Canvas, whatever you wish to do. But this is the video for Chapter 10 lecture and demonstration problems. And again, on Friday, I'll come back. We'll have more work on Chapter 10 in the Foundational 15. And then we'll move into Chapter 11 on Monday. So hope you're doing well. Take care, and I will talk to you soon.